So what's ahead for the markets? That's the big question on everybody's mind, and I'm sure on yours and family members alike. Although Randy Lert has never attended or spoken to our club, you've probably seen him on numerous occasions. In fact, even this morning, he was on CNBC talking about the financial markets. He's often on Bloomberg TV, PBS, and is the primary spokesman for the Frank Russell Company, which now is the largest investment advisory firm in the world, advising on $2 trillion in assets. In addition to being a market file, I like to call him, he is also an audiophile because he is a very avid music proponent, listens to music all the time, and also is a very avid sports car fanatic because he does have BMWs, Porsches, and Audis. So we can also call him an audiophile. Today he's going to talk on three specific topics. First, the results of the annual Frank Russell Investment Manager Survey, which is done every year as an independent research survey. Second, he's going to talk about what's ahead for the financial markets in 2008. And then finally, he does want to hear from us. So do get your questions ready. We've allocated special time at the end for Q&A. Please welcome Randy Lert, Chief Investment Market Strategist, the Frank Russell Company, to Seattle Rotary.
Thanks very much, Mark. And I also really appreciate the opportunity to follow up somebody who has real talent as opposed to what we do. Since Mark mentioned the CNBC shot I did this morning, I was walking down to it, and one of my colleagues says, "So Randy, you know what the difference is between, what the similarity is between the New Hampshire primaries and financial market analysts?" And I said, "No." He said, "Yeah, nobody knows what's going to happen." Which is true. I mean, my observation is the last couple of weeks, this time of year always demonstrates, particularly in an election year, you know, the problem with America, which is that we let real people vote and we force the real football teams to play the game rather than letting the sports writers send in the scores. And so that's a little bit the situation we're in right now, as we're talking about the markets in 2008. And I'll get to our views at Russell here in a moment, but let's just say the volatility of the last couple of months hasn't escaped our attention. And so we're aware of the issues that are being faced out there. And yet, as you'll see, both we and also the bulk of the professional investment management community remains actually fairly optimistic, particularly about investing in stocks. So let me tell you what we do. Every quarter, Russell's baseline business is actually what's called manager of managers. So we hire other asset management firms and put them together in combinations for different investment strategies and objectives. That's the best 30-second description I can give you of our baseline business, which means we have very significant relationships with the asset management community. And so once a quarter, we do a web-based survey of about 300 major asset management firms in the U.S., and we ask them their view on stuff. And what we're doing is basically have most of the survey is the same every quarter, and then once we maintain one question to be timely and topical, though the end-of-year timely topical question is always, what do you think is going to happen in the market next year? So we did that survey last quarter. The time period was November 26th through November 30th, which means it's bordering on Paleolithic in the perspective of the capital markets today. You know, I mean, that's a long time ago. Think of all the information CNBC has provided that turned out not to be information in that time frame. And but here's what the survey shows. First of all, 30% of the managers surveyed forecast that U.S. stocks would return 10% or more in 2008, and 54% forecast between 0 and 10%. That means only 16% of the asset management firms that we surveyed actually thought 2008 would turn out to be a negative year. All right? When asked about market valuation characteristics, 34% declared the market undervalued. Now, just to put that in context, the market was trading significantly higher at the end of November than it was at least when I walked in here today, though anything can happen in a few hours, so who knows what it closed at or just closed at. But so one way to interpret that is if it was undervalued then, it's more undervalued now, right? Creating more opportunity. And about a little over half, about 50% actually roughly said they thought the market was fairly valued. Now, there's a certain number of managers who assume the market is, quote, always fairly valued because they're sort of anti-market timing in perspective, but that's the baseline. In terms of within the market, managers believe that there will be a continuation of what was a sharp reversal last year in terms of sector rotation. Last year was all about large cap or large company stocks and stocks that are considered to be in what are called growth industries. And in the previous 6 years, really since the bubble, before that, we had been in a very strong small cap and value focused market. So we had a very dramatic rotation. I'm not going to get the exact numbers right, but the Russell 1000 growth index, that's the other thing we're known for. We have more indexes than really probably is required, but it's a good business. So the Russell 1000 growth index was up 11 something last year, and the Russell 1000 value index was actually negative, like negative 1 point something. Right? So what we have here is about a 12% differential between the value sector of the market and the growth. People believe that that differential will continue on into 2008 because the relative valuation of small cap stocks and large cap stocks is still significant, right? And then normally over time we need equilibrium relationships between those things. They're extraordinarily negative on bonds, though not as negative on corporate bonds as they were. That reflects the fact that the great credit crisis of August 2007 did what's called widened spreads, which means there's actually some payment for taking on credit risk now, which was not true before then, which is one of the reasons we got into the whole credit crunch mess. And so they're negative on that. They're negative on real estate. And principally positive on U.S. and non-U.S. stocks, and right now a slight bias towards more developed countries than emerging markets. I think there's some concern that the primary emerging markets, which for those of you who follow this know, have had extremely good returns for the last few years, or could potentially run out of steam, right, that they're sort of getting ahead of themselves. And so that's the baseline view of the money managers. Oh, and they like healthcare. That's perennial. They always like healthcare because they know guys like me are getting old and had to go to their cardiologist and do a treadmill last night. So they figured that's a lifelong business opportunity until all the baby boomers die. And then they like technology, and I think they like technology because, first of all, we've had some attractive valuations in the technology sector, and also capital spending plans don't look to be as damped potentially as generalized consumer demand. So that's sort of the bottom line of where the managers were at. So let me give you Russell's view on that, which is frighteningly similar to what the managers think. And if there's one thing I've learned in this business, you just don't feel good when you're basically in agreement with the consensus position. But unfortunately, we can't create another argument. And so let me rapidly tell you why I think the managers say what they're saying, and why at Russell we basically are saying the same thing to our clients. And first of all, I want to emphasize that we fundamentally as a firm believe in long-term investing, and that people should establish long-term strategic policies, and that all the kind of thing I'm talking about now should be viewed more as entertainment than as anything you actually trade on. Okay? But if you're in the industry, you have to have these positions or people don't believe you're real. So you know, we develop them, but I want to emphasize, by the way, that last year, long-term, globally diversified investors, which is what we effectively recommend for people, actually had a pretty good year, last couple of weeks notwithstanding, right? The Russell 3000, which is our broad-based index of the whole U.S. market, returned the year up a little over 5%. EFA was, which is the non-U.S. markets, was actually significantly higher than that, mostly due to currency. And the primary benchmark bond index, which is called the Lehman Aggregate Bond Index, was up 7%. So a reasonably well-balanced investor should have returned, 6-7% last year, in that range, depending on your risk profile. And in a world where inflation's running 2.5%, that's a 4% real return. That's nothing to be ashamed of. It's not a spectacular year, but they can't all be 1998, as we learned in 2000. And so, so that's where we're at. Now, here's I think the baseline argument, and it can sound a little bit like a lesser of all evils argument, but here it goes. Okay, the Fed is cutting rates, and they're clearly going to continue to cut rates. We can have a debate about how far, how deep, and how fast. But the situation in the economy is short-term rates are higher than long-term rates, right? Right now today, cash is trading at about 4.50. That's the Fed funds rate. The 2-year Treasury bond is trading at a yield of 2.75, right? That means if I give you my money longer, I get less in return. That's not normally how people think about the problem. And if I give it to you for 10 years, I get a whopping 3.85. Which is still significantly below the short-term rate. That is the bond market telling you that A, they're not worried about inflation, and B, they don't think the economy is very healthy. So that means that the Fed response ultimately has to be to bring down short-term rates, right? They have to at least get what's called the yield curve flat, if not steep. They need to actually get it steep because that's the only known mechanism for actually getting all the banks they regulate healthy again. Because banks have a basic line business, right? They borrow short and they lend long. And when you're paying more on the short end than you can lend it for on the long end, it's really hard to make that up in volume. And so that's just got to get fixed. So they're going to reduce rates. Now, what does that mean to you as an investor? You don't want to be in cash, right? Because the return on cash is going to continue to decline on a reasonably forecastable basis. Now, you also don't want to be in bonds because at 3.85, who wants to be in bonds? Right? If I give the federal government my money right now today for 10 years, they say, great, thanks, we'll pay you 3.85%. Now, you can actually locate worse investments than that. For example, a lot of people are into gold right now. I entered the industry in 1980, actually 79 as an intern and 80 when I graduated from business school. In 1980, gold was selling for about $810 an ounce. Today it's selling for $880 an ounce. Now, my observation about that as a career bet is that that was about a 9% return over 28 years, which annualizes out to not enough. Right? So these are not long-term plays that my history in the business tells me that's not a long-term play. So if I don't like cash and I don't like bonds and I don't like gold, I'm sort of left with stocks, right? And the reason we think stocks are okay is that the last time we had a small downturn in the market, the one from 2001 to 3 being roughly equivalent to the 20s, to the Great Depression in the early 30s, right? The PE ratio of the S&P 500 entering that particular little traumatic event was over 30, right? So stocks were very highly valued based on actual corporate earnings. Today, the PE ratio of the S&P 500 is about 16 on a trailing basis, meaning last year's earnings, and because earnings aren't looking real swell for the upcoming year, it's about 15 looking forward. But that's not high by historic standards, and in particular, it's not high when interest rates and inflation are contained. It's just not. The thing you have to always look at when you're looking at financial asset valuation is what is your investable alternatives valuation characteristics. Low interest rate and low inflation always allow stocks to be, quote, more expensive, unquote, because the fundamental cost of capital in the economy is low. And by the way, that's the problem the Fed is clearly struggling with. The cost of capital isn't really super high. It's just that nobody wants to lend it, right? And so this recession, which I don't actually think we're going to have, they're doing a fire drill. I went through this in the lobby already earlier this morning.
Fire alarm, evacuation system, and the North Tower stairs. Please disregard any alarm you may hear. This
See, they really don't like my forecast. So the problem we're having, and by the way, we don't think we're going to have a recession. We think we're going to skim really, really close. But it is important that the technical definition of a recession is 2 consecutive quarters of actual contraction in GDP. And right now, even the negative survey evidence does not lead us, at least, to say there's going to be a recession. Is it impossible? Oh, no. It's very possible. But it's not, in our view, the likely outcome. But we're going to get really close. We're going to get super, super close, right? So in that kind of environment, what we have to sort of think about is where are our baseline opportunities, and they still remain in stocks. Because stocks will have to have a major earnings hit, in my view, to come down significantly from where they are today. Now, of course, my view is that we had a floor at 1,400, and we demonstrated I was wrong yesterday. So, but 1,390, 1,400, it's close. So basically, that's where we're at. We also like non-U.S. markets. First of all, we believe you should always have exposure to non-U.S. markets. It's a global world. In terms of active stock picking these days, any large cap stock picking exercise is really a global exercise. It doesn't really mean anything to have a U.S. pharmaceutical company or a U.S. steel company or a U.S. auto company. They all compete worldwide and globally, and that's their competitive framework. And if you're going to be making judgments about owning those stocks in an above average weight, you're going to have to think about that judgment on a global framework, not on a purely domestic framework. So that's our overall perspective. That's what I was going to point out. The problem the Fed is having right now is that credit is a little expensive in the environment we're in, but it's not outrageous. It's just that nobody wants to lend. And this particular economic slowdown is being driven not so much by an inherent lack of demand, which is the normal cause for a slowdown. There's plenty of demand, actually, for credit for investment and consumption purposes. There's been some unwillingness to lend because of the lack of transparency in many borrowers of the past few years. I'll just put it that way, in terms of who you're actually lending to. And so that is part of what also has to get fixed in the regulatory environment. But our view is it's going to probably get fixed. It's going to be a little nasty here the first few months of the year. I likened it to my table mates to I fly a lot, is that even though I fly a lot, I don't care a lot for turbulence. I notice I respond negatively to it when it happens, but I've also learned it's a uniquely bad time to try to exit the aircraft. And so I hesitate to even make that statement with an aviator staring at me here. But nonetheless, that's the environment that we're in, and we really think by the second half of the year, things are likely to look better. The Fed will have cut. That will allow some multiple expansion and probable recovery in the baseline economy. So I think I've got about 5 to 7 minutes left for questions, and so I'm going to stop right now and go there.
We are being televised, so please make your comments and questions very vocal. Thank you.
Do you have any currency projections, the U.S. dollar versus foreign currencies?
I hate currency. It's a very difficult market for a number of reasons, the biggest one of which is that you have what are referred to euphemistically as non-economic players in the currency market. You can read that as central banks who are trying to influence public policy, and they're not trying to make money. Markets are so much easier if you just realize everybody's just trying to make money. But my long-term view is that the dollar is and probably will be overall in some period of decline. Generally speaking, ultimately, currencies reflect the proportionate output of the world that a country contributes. And we are a mature economy, and there are other economies growing faster than us. That means our proportionate contribution to world output will probably decline or be flat, and so that will be reflected in the dollar. In the short run, I actually think the dollar is, to use the bad phrase, oversold, and probably should recover, particularly against the pound and the euro.
Can you tell me a little bit about the integration of computers in buying and selling decisions? And does that account for fairly large swings in buying and selling on any given day?
Okay. By computers, if you mean quantitatively driven investment strategies. Yeah, well, they've been around. Actually, that's my entrance into the industry. I was the first generation of investment guys trained in business schools how to do that. And so that's been about 30 years now. So that's been a fairly common feature. I can't actually underestimate in total, however, the impact of computational ability on the asset management business. When I was right out of business school, we still had to do all of our analysis on old-style time-sharing mini computers, companies like DEC and VAX and Prime, and you have to be like my age to remember those firms, right? And it cost $1,500 a throw to do one portfolio analysis, so your boss wasn't interested in extensive sensitivity analysis being done. I mean, today, right, I mean, how orders of magnitude more computational power and the marginal cost is effectively zero. So there's no question it's transformed the business in terms of its ability to do risk profile, risk management. There's all kinds of fixed income instruments that couldn't even trade if you didn't have the ability for computers to calculate the value of the embedded options in real time, because no human's going to do that. But I don't actually think it's contributed to market volatility. And in fact, we feel volatile right now, but we're actually about average for volatility. The last 2 years, we're way below average in volatility, and the way that behaviorally works with investors is that when we enter periods of changing volatility, it feels much worse to us than it really is, or better than it really is, depending upon which direction we're headed. And right now, we've gone from way below average volatility in the stock market to about average volatility in the stock market.
Can you give us your thinking on real estate investment trust in this market cycle?
Well, first of all, we're a believer in real estate investment trusts, and as a matter of strategy, we overweight the bulk of our clients in terms of exposure relative to market cap into REITs. And they gotten hammered a little bit, so their valuation is a little better than it was. They do, in my view, for a taxable investor, constitute something of a problem because they're massively tax inefficient, right? They're basically income distribution devices that get taxed at ordinary income tax rates. So what I actually really recommend to people is to hold them into your tax-deferred accounts, and then just, like most things in your tax-deferred account, forget they're there until you're 60. So I'm not as negative on them probably as I would have been this time last year. I wouldn't be rushing out to put a lot of money into them. Though the commercial real estate market is significantly healthier than the residential market, in my view. So one comment I will say, that people consistently underestimate the depth, the duration, and the nastiness of residential real estate cycles. Right? And there's no question in my mind that we're not going to have a recovery in 08. And the term recovery needs to be used loosely here. If you really study the history of real estate cycles, particularly in markets that excel in them, like California and Arizona and places like that, even after they, quote, recover, prices stay flat for an extended period. Think years, not months. Right? So making money in residential real estate, that's not likely to happen. My own view has always been you should view your house as a place you live and not as an investment. And I continue to take that view despite the fact I own too many of them. So.
Some commentators have posited that at the present time, one of the core issues is that the banks simply do not know what their assets are. And the reluctance of the banks to lend is tied to the fact that they don't have a hard figure on what their assets are. Could you elaborate on that?
Yeah, well, first of all, I think that's correct. Boy, getting into complex mortgage derivatives in a minute and a half for Beatty is complicated, but basically the logic of the way these things have been created, which you hear a lot of talk about how could it be a AAA security, yada, yada, yada. Here's how that works. I take a whole bunch of loans, even shaky credit loans, right? And I have a reasonable statistical certainty that 100% of them won't default, right? So what I tell somebody is I tell them, I'm telling you that AAA tranche, which will be the first 15% of these loans that actually pay off. So whatever pays off, you get it first, right? And then the next guy gets the next tranche, and it's up, they pay second, and so on and so forth. The problem is that there's no transparency right now into what these underlying payoff rates look like. Now, what that's resulted in is something actually that I think ultimately will turn out to be one of the opportunities of the next 2 years, which is some of these things are actually trading in the open market as if they are going to 100% default. And the only thing I'm positive of in the financial markets is that nothing ever happens 100% of the time. And so what will happen here is that some of this stuff will be made good, but right now you can't get a bid on it. So it's what's referred to as price discovery. So that means they can't value what their book looks like, and that does create a reluctance to loan because they have to maintain reserves, right? They have to know their asset base and their liability base because they're regulatorily required to maintain certain levels of reserves. So that, in a nutshell, is the problem. And hedge funds have become a new financing intermediary in addition to the traditional banks, and that's the other thing that's going on. So, for example, you may have noticed, I think it was Citadel, but I'm not positive, went in and made a rather significant investment in E-Trade, in some of E-Trade's mortgage portfolio. That's a good example of the kind of bottom fishing I was talking about, where they're saying, well, we can buy this stuff so cheap, we'll buy it, and they actually have the money, right? So they're entering the markets right now. So there's some of that going on.
Yeah, actually, a follow-up question to the banking, last banking question. I've heard estimates that between 3 and maybe 6 to 7 trillion with a T dollars of real estate value will probably go into the ether, between now and 2010. If that's the case, and homeowners aren't able to extract equity to borrow money to pay for stuff and sort of continue our consumer economy, contrast that with a bullish forecast for 08 and maybe 09.
Right. This is not going to sound like a very good technical answer to that question. First of all, I think it's hard to know exactly what the vapor loss is going to be in the real estate market. But I'll tell you this, for 20 years, I've had money managers pumping into my office explaining to me how the American consumer couldn't possibly spend any more. And for 20 years, they figured out a way to do it. And actually, consumption is much more driven by jobs creation than it is by credit availability. And the actual credit card balance of Americans is about $2,200. When you take out those who run up big numbers, like corporate American Express cards that automatically get paid off every month. So the level of indebtedness on balance, I think, for the American consumer is fundamentally overstated. That's my personal hypothesis. I have no idea if that's actually the truth in terms of why we still can figure out ways to spend. But we do. And so that's not the number one worry on my list, actually. Not to mention there are clearly growing consumer economies in the rest of the world that we serve, and we serve heavily. I believe this is still true. This is by statistic of the year. In terms of unit volume, the number one market for BMW 7 Series is China. Now, see, that's the power of a very tiny percentage of a very big number, right? Because there are not that many rich people in China as a percentage of the population, but there's enough given the size of the total population. And so that's part of the other reality of the new world that we face now, and there will be people taking advantage of that. Tell them I'll hang around a while.
Special note on Randy here today. This program could have gone on obviously a lot longer today. He will stick around after for anybody that wants to talk and ask him questions one-on-one. Thank you so much for being here, and forecast for the markets. It was never said better, Randy. Thank you.
Seattle Rotary Online is made possible in part by a grant from First Choice Health, working with the Washington Health Information Collaborative to use technology to bring better health care to patients throughout the Pacific Northwest. First Choice Health,